This session, it is of interest to founders. It does say in the title as well, it's for Series A founders and beyond. However, if you are an investor, I think it's also interesting for you maybe to listen in and participate, because some of the funding options that we'll be covering today could be a great complementary option to your fund or perhaps to your portfolio companies. There are obviously loads of alternative funding options out there. Today we'll discuss three particular ones, which is media for equity, media capital, service for equity more broadly, and security tokens, and venture debt, but a slightly different form of venture debt than probably the usual venture that you know. And on that note, I would like to ask my guests to introduce themselves, but importantly, what your fund does or how your model basically works. And maybe we can start with Neville.
Hi, good afternoon. Thank you. My name is Neville Taraporewalla. I'm the president of the Times Group North America. I actually lead the strategic investment arm of the largest media group in India, based out of the United States. And one of the interesting things that the media company did way back in 2005 was to create a strategic media fund which invested in early stage companies to actually build their brand using media assets in return for equity. And over the period of 15 years, they've been pretty successful. There are over 900 investments in India. And in 2015, we opened an office in Silicon Valley where we are actually leveraging the US-India corridor, where we are looking at companies which are looking at India as a big market and are looking at getting to India. And when they get to India, being a mass market, they need to use media out there. And the fact is that as a company, we operate the publishing business, television business, radio. We are across all media platforms. That's, it's a very powerful combination that we offer. So, and we invest off our balance sheet every year. That's what we do, media for equity, and it's been pretty successful for us. We've got close to 35 investments internationally now going into India. Right at the top of the pyramid, we've got investments in Uber, Coursera, Airbnb, to just talk about it, and then we have growth companies, early stage companies, and we've been pretty successful on that front.
Thanks, Neville. Flavia?
Hi guys, I'm Flavia. I'm Chief Commercial Officer for Velocity Group. We have two parts to the fund. The first one is venture capital. We have backed over the past 7 years direct-to-consumer businesses, so new emerging brands from very early stage to kind of Series A. And 2.5 years ago, we launched our own finance house. This is Velocity Juice, and we've introduced a product that was really needed in our market, was needed by our companies. The vast majority of the capital, working capital of new brands goes into advertising, into marketing, into inventory. So we wanted to create something that is a lot more scalable than the traditional kind of venture debt products. And this is exactly what we have done. We have partnered with a very large multi-billion institutional provider, and last year we have tested. We have managed to put quite a bit of capital out there, backed a few organizations. We can do anything from 100,000 to about 8 million, but our product is recyclable. So companies with 5 million or so, they were able to draw down anything from 5 to maybe 20 million in a year. It's very different than anything that you probably would have seen out there, and I've experienced working for Silicon Valley Bank for a few years. So yeah, it's very exciting. We're quadrupling our budgets this year, and we work a lot more and more with private equity companies that want to be able to sustain long-term activities like TV and sustain an omni-channel strategy, which for brands, as well as technology companies addressing consumer markets, is becoming harder and harder and more expensive. So yeah, I'm very excited to be here. Thank you.
Thanks, Flavia. And I'm glad you mentioned that association with the TV and media funds, because I think we'll circle back on that and how basically all three of you actually could potentially support each other, but most importantly, support the founders that are raising. Jonathan?
Thank you very much. My name is Jonathan Clark, or Johnny, to my friends, and I run marketing, sales, and business development at a company called Consilience. Consilience is a software company. We have pioneered a technology called fungible asset-backed security tokens, and we believe this technology will disrupt large parts of the venture investment, private equity, and real estate markets, amongst other things. Not being one to do things by halves, we decided that the best way to prove that this works was to start our own VC fund that is powered by our software platform. So 3 years ago, or nearly 4 years ago now, we did that, and Consilience Ventures was born. Consilience Ventures invests in seed stage at deep tech companies. We boast quite a strong portfolio, and we've co-invested with some of the better known names in UK venture capital. And the concept around what we do is that through tokenizing part or all of the equity of a portfolio company, you can create a more liquid element of that company. It's much more frictionless and much easier to transact digital representations of that company's equity on our platform than it is to do company's house filings. Every time you want to pay an advisor with equity, or you want to pay somebody like a consultant for a specific piece of work with equity. So obviously that has applications in other industries, but that's what we do. The portfolio is going great, and we're currently signing up a number of other venture studios, incubators, accelerators, and funds as we speak.
Thanks, Jonathan. And we'll actually circle back on the offering for investors as well, because I think the first model, the fungible asset-backed model that you are creating for both investors that are raising their fund, and I'm sure a lot of them are in the room today, could be of interest as well. Flavia, I want to go back quickly to you. Before we delve into both and all of these different models, maybe let's discuss what kind of changes have we seen in our portfolio companies. I was just reading the latest State of European Tech report, which came out in December last year, and I think over 80% of the founders that took that survey, the whole founder sentiment completely flipped dramatically, with 80% of them just saying that, look, I find it extremely hard to raise money compared to 12 months ago. And just to put things in perspective, this is a report that has been running for 5 years now, and this was the biggest change they've ever seen in founder sentiment. From your portfolio companies, where have you seen the biggest change in terms of stage of growth, but also thinking about the sectors as well? Where do you see the biggest gaps?
That's a very tough question. I'll do my very best. Okay, so we've come after a period of booming, of capital going into anything from SaaS to fintech to life sciences during lockdown, and consumer space as well on the same type of valuations. Last year, as you would have seen, it's not necessarily the sentiment for the founders, but capital. There's, last quarter of 2022, it was really depressing. We reverted back to a level of, 2018. So it's quite a dramatic shift. Also in stages, so early stage always gets more affected than, let's say, a company that already has 10, 20 million of revenue. So naturally we've seen this, I would say, vacuum of capital at specific stages, and then consumer space being basically decimated, so 70% contraction, which means that if you are a consumer company being able to bring a new skincare or fashion or even a gaming application for consumers, you're finding it a lot difficult. It's not just the venture capital, which we have quite a lot of data on, but it's the private capital that really reined it in. So I'm expecting that potentially at the end of the financial year, which is the end of this quarter, we're going to see kind of a flip upwards, because usually private capital tends to match, at least in the UK, the taxation benefits and the kind of cutoff points. But overall, I think, and it's not just myself, I think there are a lot of people in the industry that really see this market for funding, equity funding, contracting, which means that if you have something valuable, you have some revenue, you have to think about alternatives. And venture debt and a number of different range of products, they're really benefiting you. They're releasing the cash early on so that you can continue to do this growth exercise. And when the market picks up again, and it will, you can then be in a market and not be penalized, not have a down round, which really affects the confidence of founders, but affects the team. Have you ever seen a company that has done a down round that everybody was really excited and made it to $1 billion valuation? Probably not, and if you have, it's like 6 standard deviations from the normal. So yeah, this is what's happening in our ecosystem. We're very, very blessed that at least in Western Europe, there are quite a lot of funds that are sitting on a lot of dry powder, probably somewhere around kind of 100 billion, and more organizations like ours raising their own funds, bringing 20, 30 million, 100 million here and there to bring new products to help you fund specific elements of your business, and in some cases working capital. So I think that that is encouraging, that we're at least geographically in a part of the market in Europe that still has an appetite and a lot of capital that needs to be deployed and needs to produce return. So that's a good thing.
But in fact, actually, venture debt, out of all the different funding options, has been growing the most in the last couple of years. And also another thing that I've seen from, and I've heard from different conversations, there's a lot more bridge rounds that are happening right now. But I just want to...
Maybe it helps if I just, for anyone that is not aware what is venture debt and what the type of products, I think, we kind of use the terminology, but many people will know venture debt as a form of finance that is really associated with VC investment. Venture debt comes sometimes towards the end of a funding round. Starts at kind of Series A and B and C, and can be quite substantial. Could be anything from like 20% on top of the equity, or it could be a complete departure where we are giving you maybe twice as much of equity. Twice as much of capital opposed to equity. So from that perspective, it's a finance product that really fuels growth. So you need to be on a very good growth trajectory in order to use it. If you have equity rounds, it complements it very well because you have now your runway and you can do those exercises to build your top line. So that's venture debt as a product. It's not a term loan like a bank. It's not a program that the government would fund. This is pure return-focused solution.
But Velocity Juice, and we'll come back to that, I think it's a very specific type of venture debt, as we discussed, especially in terms of the kind of startups you're looking at, but the way you deploy the money.
We're loyal, yeah. We're loyal to consumer companies that have digital distributions, companies that actually you can't have a business without your omni-channel, without doing digital advertising, TV advertising, in-store promotions, and etc. This is how discover, buy, and eventually end up addicted to products, some more than others. So that's where we sit in. We're very, very specific niche. Our market is around kind of 22 billion just here in the UK. Companies that we find on our shelves in supermarkets. And this is, our solution gives them an ability to tap into 10 times their monthly revenues. So that is a complete game changer for the industry. It means that a company with 200,000 of monthly sales can now access a 2 million credit line. So be able to transition from, and I'm more than happy to speak with people interested, transition from a 2 million annual revenue to maybe a 10 million in the space of 12 months. And we work to help companies understand the deployment and have that marketing expertise to be able to do those scale-up exercises. They're very different for a consumer opposed to, let's say, a SaaS company or a fintech company.
So, Neville, if all these drastic changes, we're seeing them at late stage, and Flavia also mentioned about the consumer gap in terms of investors, I think it's predominantly in UK, Europe as well. And we know from previous research that a lot of these late stage companies, 30-40% of their spend, the marketing spend, or their actual budget goes towards marketing spend. Some of them, like Robinhood, is up to 50%. In such a market where it's becoming even tougher to fundraise, and then half of your money goes into marketing anyway, why should they look at media for equity?
So one of the USPs that we talk about our product really is that when we come into play, we actually are going to be sitting in your cap table. So if you're a CEO of the company, I think it's very important. Your marketing will cost you 50%. You don't want that sitting in your OPEX. I'd rather have, as the CEO, all of this marketing investment that I'm getting to sit in my cap table, because it's the risk that we are taking with the company. And I think that's a very powerful piece of information that the CEO of the company really digests easily when we go and show him that product. And as long as the company is got a run rate, as long as he's got investment to run his product, have a good product, the one thing that most people lack, and I can speak about India because it's such a large market, distribution and connecting with people is very difficult. And that's the power that we bring to the table. And we've seen significant amount of success. And I want to actually talk about an example. Amazon had a $5 billion check to win India. And India had a homegrown e-commerce site called Flipkart, which most of you might have heard. It was competing with Amazon. And we invested 100 million rupees around the time it was $4 billion valuation. And they needed that investment because they couldn't compete with Amazon, who actually had a $5 billion check to market Amazon in India, reaching out to consumers across all media assets. And what it did for Flipkart, it actually flipped its entire branding campaign. It sort of converted it, and it not only built the brand per se, it got customers, it also built the valuation of the company. In walked Walmart after a couple of years and bought it for $16 billion, right? So you can see the upside as a media company, what we've achieved, right? We entered, it was at about 4 billion, we walked out at about 16 billion. So the branding does help, marketing aggressively does help. So it all depends on where the company is, what's the life cycle of that company, at what stage it is. And therefore the media for equity is a very powerful tool or a product, if I may say so. And we've seen some great success. Flipkart is just one of the examples which I'm just talking about.
I mean, we obviously have a panel discussion dedicated to media for equity at 4 p.m. and Brand Capital has invested in many other businesses outside of India, including What Three Words, which will be joining us today. I know we haven't talked about how it works. We'll discuss that in the afternoon, but basically the very basic idea is that a media company such as Times Group would exchange the inventory in exchange for, will get an exchange equity for equity. But there's so much more other than just that transaction, and we'll cover the benefits as well at 4 p.m. I just want to quickly cover the Consilience model as well, because I know the title said Series A companies plus companies. I think what Consilience does, I think that solution, and I like to call it like a one-stop shop solution for any founders that need not only cash, but potentially trading for services like media inside Consilience or software development or any type of expertise for that equity, right? But I think this is an interesting model specifically for an earlier stage company when you're just getting started, you need maybe your finances in place, you don't have a CMO perhaps in your team, and that cash component. What are the advantages of using Consilience as opposed to, for example, doing directly a media for equity deal or doing an equity deal or raising cash from early stage investors?
Sure, absolutely. So I think to answer that question, it might be best if I sort of give a little bit of my personal experience. So I don't know if you can tell by the accent, but I'm actually from Liverpool in the northwest of the UK, and I tone it down for events. And Liverpool, indeed really the entire north of the UK, and actually many of the ecosystems or tech startup ecosystems the audience members will be from, you will probably have experienced this kind of polarization where the majority of capital and the majority of deals are done in the UK, it's London and the southeast, and it's probably your capital cities or other kind of second tier settlements. And if you're a founder or even just an entrepreneur, it doesn't even necessarily have to be tech, trying to grow your business in one of these lesser served areas, it can be quite hard to know where to go, where to get that cash. I meet a tremendous amount of founders in the north of the UK, and I look at their business, and any of us sitting on this stage or in this room would go, oh, that's a B2B SaaS platform. You could raise some angel investor money, you could get some early stage VC, and you could scale this internationally. But if you said that to the founder, they'd go, what's an angel? What's B2B SaaS? What's a VC? And therein lies the problem, that these underserved communities in particular, like where I've come from and built my business in the past, before I joined Consilience, they don't have access to the same quality and volume of capital markets. So being able to join something that is online and creates enhanced liquidity is a big bonus. But what a lot of those areas do have is a lot of goodwill. There's a lot of ecosystem builders, startup communities, maybe people who work in some kind of small early stage incubator. And they are often cash poor in the context of investment, but they're time rich and they love working with founders to help them build their businesses. And so you're exactly right, Diana. On our platform, we do see a lot of tickets for our seed and Series A stage companies asking for, we need a full stack developer, we need an AI developer. But actually, we see a lot of quite specialist ones as well. So we've got some real kind of medical deep tech on there. We got a request for a cellular metabolic chemist.
I trust you on that.
Yeah. So not something
I'm not
I'm
going to argue with you.
Exactly. I'm a geographer by background, so I know soil and rocks. That's about it. But we do get some very specialist requests on there, and the benefit of having a large community. So we've got about 350 vetted, curated members in our Consilience Ventures network who assist these startups, and we keep it difficult to get in deliberately to maintain the quality. The startups and their existing investors and the other investors in our round know that they are getting a really high quality service from specialists that have skin in the game because they're being paid through a digital representation of the equity in these companies, not just in that one company, but in the entire portfolio. And so the benefit over just raising some cash, if you can do that in some of these places, is that it's not just a straight exchange of cash for equity. I mean, I personally have been burned in the past just getting a website done. So I wouldn't want to spend 50, 100K on some of these more specialist services that require labs and cell testing and regulatory licenses, not to get the desired result. So there's definitely an alignment of incentives argument that underpins a lot of what we do, as well as just creating what we all believe to be a stronger business case for these companies that are in our portfolio.
And although it is decentralized, obviously there is a community that governs the network. I know, being part of it, how much time it takes to be sort of vetted before you get in. And obviously there is a committee that looks after the token and the value of that token, and it's been revisited a few times for the past, the last few years. I think we spoke about this, but what would be interesting perhaps for the audience to know, what you're seeing in terms of your portfolio of companies, what do they actually need most? What is the service that gets traded the most on the platform, apart from, I suppose, probably cash? But what other services do they need?
Yeah, I mean, some observations about the portfolio. So, it's no secret that the tech investment market has slowed down over the, since the 2021 boom. What I would say is probably because a lot of our businesses are deep tech and they have these much longer go-to-market periods, but also longer life cycles in general. Their growth is kind of maintained a little bit more steady, I would say, than some of the other things in the tech market right now. In terms of what they're asking for, yeah, we do get a lot of those niche requests around cell biology and organic chemistry, advanced mathematics and things like that for the deep tech ones. There's always a huge demand for back-end development, lots of Java, Python. There's really not a month that goes by that I don't see something related to Python being requested on there. Again, I don't want to say that that's an observation of the wider market in general. I think that data is probably a little skewed because of the nature of the companies that we've invested in. But the number of people that come forward from the community to answer these work tickets and the speed at which it's done and the overall satisfaction of the companies in the portfolio tells me that the model's working. And you're right, we've so the tokenized part or the token CVDS of the platform gets reevaluated on a frequent basis, and we've witnessed just under a 3x return in the portfolio over the past 2.5 to 3 years, and that's even incorporating the kind of slowdown in the tech market and worries about a lot of companies' valuations going lower. So we're really happy with the results on that.
I think if there's one common ground that we all share here, just from what I'm hearing, it's obviously that kind of the service that gets traded. Obviously, Flavia's model is non-dilutive, but it all kind of circles back to marketing and other levels of support. And I know we talked about PR essentially being traded and asked for on the platform as well, which is interesting because I think in this current market, there's a lot of gaps in terms of consumer funding options. We don't have, unfortunately, that many consumer companies here with us in the room, but perhaps some of your portfolio companies are consumer businesses. Where do you expect, what's the next trend in venture capital? And maybe we can start with Flavia. Where do you expect to see the biggest changes? What do you see in your portfolio companies right now? What are the biggest changes happening there?
Well, if we look at one part of our group, we're seeing, like everybody else, once you have done your kind of 50th investment, you probably would have learned quite a few lessons. So for us, it's about going and helping companies from a particular point, but they have some validation of their solution, to the next stage when they're virtually in a whole region, from your supermarket to online to whatever media you're accessing. You can find out about that brand, about their products, and they're continuously innovating. They're continuously bringing more and more products and ranges to the market. What I'm seeing overall in our ecosystem is specialism. I think that if we just look at the US, a couple of decades ahead of us in terms of numbers, capital, deployment, etc. Specializing into a specific vertical is the next thing. In Europe, the very large funds still do agnostic investment, but the more you look at the new GPs, and I'm sure that maybe there are people today, you actually find that there's a specific part of the market that you're addressing a lot better. You're able to add a lot more value. And similar to ourselves, you're probably thinking about all the different ways in which you can capitalize a company to get it from $1 million of revenue to 20 of revenue annualized. And for us, it was about this scalable, very exciting product. For Flow Capital in the US was the sort of vanilla venture debt products, so the working capital alongside equity. And I think that this is where our market will go. We're going to be much more smarter how we deploy and much more reliant on these complementary solutions. At different stages, there will be different ones. Maybe it's media for equity when the company is already 10, 20 million of revenue, but now needs to get to 100 million of revenue. Maybe it's about trading services and keeping the operational burn lower so that we can get from seed to Series A, which is the biggest loss, right? More than 50% of companies die somewhere along that period. And then there is the alternative capital, so the products, the debt products. And when I joined from Silicon Valley Bank, more than, I would say, almost 2 years ago, there were probably like 10 companies with very similar products, like revenue-based. Now, I'm looking at Europe, there are probably more like 40 companies servicing the market with different solutions, some that are unimaginable. And I think that that's a good thing. That's an extremely good thing. So we're going to see these products moving from the West to the sort of the rest of Europe, and then more funds because they see it works. And that will enable more and more companies, irrespective of where they are, to get from one point of growth to the next one. So I'm an optimist. I think that the recessions and everything is a cycle, and you just have to think about capitalization very differently than we have done before. Equity, 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 equity. There may need to be a different cadence. Equity, debt, equity, debt, equity, debt. Media for equity, and hopefully be able to calibrate it in such a way that you're transitioning to the point where the company can again be valued and priced externally.
I think there's no doubt having that mix of funding options makes a company more resilient. And I want to go back to Neville and hear from you as well. Just before, I wanted to say that we might be able to take a couple of questions or any comments from the audience in the next 2-3 minutes or so. And I think we are just running a bit behind schedule because of the previous session, but we will be wrapping up in 10 minutes or so. In terms of media for equity, Neville, there are loads of options in the UK, loads of options in Europe, not so many options in the US in terms of having a company, and we know from portfolio companies that are based here that are trying to make their way to the US to work with a media for equity fund, because it doesn't exist yet. Where do you see the next big thing happening? What's the next big opportunity in this space?
So if you really see what's happened in the last couple of years, most traditional publishers have really given way to Google. Okay, if you look at their inventory, which they are not able to sell on the digital platform, they would give it at a peanuts rate to Google, and they're very happy because they're getting a check at the end of the month. And I believe the next big thing probably would be, I know that in the US, a couple of media houses are doing media for equity, in a very small way within their own groups. But I believe that it has to have an independent media fund, which will build an alternative stack of different media assets, which will then take on the triopoly, as I call it, which is Google, Facebook, TikTok, and
Amazon.
Yeah, because there is a lot of business which is there besides these guys, but the fact remains that the traditional publishers are definitely struggling, whether it's a television station, radio station, newspapers, etc. And most of them are very happy giving away their inventory to Google for 10 cents and maybe 2 cents or 3 cents. And when I've met some of them, they're a little concerned that, oh my God, my monthly check will not be there. But if they were to go for an independent media for equity model, the chances are they're going to monetize that inventory at a far higher price through brand advertising, through these new companies which are coming. Because when you look at the 10K reports of some of these companies like Robinhood, Coinbase, etc., they've spent almost 40-50% towards marketing, and most of that marketing has gone to Facebook and Google, and cost of acquisition on those platforms is very, very expensive. So I believe that going forward, I'd ideally like to see an independent media fund, and if publishers get together from different platforms, I think that it's a formidable challenge which could come into play.
To achieve, indeed. And I think how you explain it, I think the upside for the publishers is very obvious. I think for the founders as well, it's not just the pure transaction of media, but when you're going to a market like US, relatively fragmented, you've got basically not only the amplified reach that you would get through an independent fund, but the support, the expertise in terms of how you're going to adjust your creatives to that market. How do I do the messaging and the branding in a way that fits with that market? I know there are examples even here in Europe, and I think Zalando was one of the big examples that was always referenced as the main company that has raised media capital, and it went on a formidable journey. But I also know, and probably not that many people know, unfortunately, when they scale from, I think, Germany, they tried to go into Austria, which is, we all think it's a relatively similar market. That campaign actually didn't work for them.
Right.
It completely didn't work. In fact, I think it got a lot of criticism, unfortunately. And I think a lot of the small things are sometimes overlooked because a lot of the founders and we all start putting money into digital spend, and then traditional media is somewhere out there, but not necessarily on our trajectory.
So the reality is that Google's getting all its page views for monetization through digital websites, right, which they don't own. That's the reality. I mean, and most of these websites, it's easy money coming in, right? But they're getting a chicken feed money. I mean, so there is an opportunity. There's an opening out there. There's an opportunity, and I believe that that's the next big thing, which can be a pretty good competitor to address this problem.
Yeah, and Jonathan, I mean, there's so many things happening at Consilience. I find it very hard to keep up with you guys. I think just last week you started your fundraising campaign on Cedars. What's next for Consilience and implicitly for your portfolio companies or companies that would like to raise money and services with Consilience?
We are doing an investment round, part of which is now live on Cedars. Capital at risk, don't invest unless you're prepared to lose all your money. I think I've got to say that as a disclaimer. Cedars made sense to us because there's a very real, tangible business mission to what we do. Ultimately, we want to support founders, but we sell, our product is geared at the funds and the asset owners and portfolio managers who are the kind of in between us and the founders. And the kind of underlying holistic mission of what we're doing is trying to democratize access to private illiquid assets. Why? Because those asset classes, whether it's VC or like large commercial real estate, they've performed much better than the asset classes that regular, what they call retail, average Joe and Jane have access to. And I think that just strikes everyone in the Consilience team as a little bit unfair. People can spend their life trying to chase a 4% return in a low interest rate environment using, bonds in their ISA in the UK, but there's people making, 10x and plus more in certain vintages of venture capital funds in different markets. So that's the underlying mission, and that's why it kind of made sense to us to add a Cedars campaign onto our, I guess you'd call it our seed round. Obviously, it's because of the nature of what we've done, not many software companies go out and start their own venture capital fund to prove that the software works. So we don't look like a traditional company. We're not EIS eligible for people wanting to invest, unfortunately. What's next? Well, we are, now that we've proved the model works, we are expanding quite a frightening pace, which, it is very busy. And no day is the same. We've got prospective clients in the pipeline, everything from hotels and billion-dollar real estate developments in the USA to some very well-known venture studios and accelerators in the Gulf region, right the way through to things like more traditional venture funds in Southeast Asia. And there's some unifying traits to all of these customers. They all want to use our fast platform to enhance liquidity, to make their lives easier, because it's usually cheaper and quicker and easier to do than the traditional SPV offline legal process for them. But a lot of them are also aligned with the mission of opening up their investor pools to more people and ultimately providing a better service to their clients, whether those clients are founders, LPs, other people that are entrusted, that they are entrusted with the capital of. So, we're gonna close off this investment round over the next 2 to 3 months. That capital is going to give us the fuel to, over the next couple of years, achieve quite significant scale. We've got some pretty big milestones, and we've got some, even before the Cedars campaign ends, we've got, a number of announcements over the next few weeks. But, the best way to come along with the journey is to check us out on social media, or please do come and grab me over a coffee or lunch. There's a lot in the pipeline. And just finally, as for the Consilience Ventures portfolio, that really is going from strength to strength, and we're starting to see our portfolio companies now approaching their next investment rounds. We've got a number of things in store with Consilience Ventures, not only as a business in terms of how we expand it, increase that network size, add to the quality, potentially add to the portfolio, but also in terms of the product roadmap, because compared to when we first launched it 3 years ago, we've got a lot more kind of experience under our belt now. And so there's a number of quite exciting features that my colleagues, Pierre and Sankalp, are going to be unveiling on the product side on that. So look out for those.
Thanks, Jonathan. I just want to see if anyone has any questions or comments, or their own, if you are an investor, your own kind of experience, I guess, or what you're seeing with your portfolio companies. Yes, please. Yep.
Neville, I guess just on the, I understand you mentioned it well, and we don't price the round at the time that you are taking the investment, but I guess when you're pricing around for the media for equity today, does that impact the way that outside investors in the future might think about the valuation of the business, or just how do you think about that, especially given the price of a lot of marketing is going up from the people that you're talking about, and the market is, showing more aggressive pricing on the equity side?
Yeah. So when we do all one for one. We don't give any discounts. That's the big thing which we do. We invest. We work with the marketing team to figure out what's the kind of money they need to reach a certain point in a certain year. So if it's $5 million that they require over 5 years, we release $1 million worth of media every year. Then what happens is, once the investment is done, the marketing teams go across to the respective media assets, and whatever the rates are. So it's not that if you do a media for equity deal, you're going to get discounted rates. And when we enter the company, we enter exactly with all the other investors. We are not discounting at all. And that's been one of our successes. Because the moment you start discounting, then the media gets discounted. We are not really doing that. So whatever the rates are, yes, once the deal gets signed, let's say you're doing a $100,000 campaign or $200,000 campaign, you may get better positions, you may get better prime time, you may get a hoarding which is in a better position. That's all you might get, but it's not discounting the rate in order to do the investment, or vice versa. I think it's a Chinese wall that we maintain, because otherwise it doesn't make sense.
Any other questions or comments? No? I think it's probably time for us to wrap up and get some lunch. But I do have some action points just to kind of sum up the different funding models, and obviously if you want to speak to our panelists. So essentially, if you are a scalable consumer-facing company, or you have portfolio companies that fit this category with fast-growing marketing spend, I think you should, first of all, you should come here at 4 p.m. And watch the Media for Equity panel discussion with ITV, German Media Pool, and Nia from the Times Group, and two companies that have raised media capital before. But you also can grab Neville after the panel discussion and speak to him. If you're a seed, late-stage company that is looking for more than just cash, but services as well, and the support from the network, and almost just plug into this one-stop shop that I like to call Consilience, talk to Jonathan. And if you're an e-commerce founder in need of fast, flexible cash injection, we can say that, to cover your marketing costs that could potentially propel you into a TV advertising campaign, or covering those costs that are correlated with your TV ad campaign, then talk to Flavia. She'll be here with us hopefully till the end of the day, and at the after party as well, where we can chat more, I'm sure. Thank you so much for joining the panel discussion. I hope everyone found it insightful, and let's go for lunch. Thank you.